How's it going today, guys? I hope you're having a fantastic day. So in this video here, we're going to be talking about this idea of waiting for the stock market to crash before you begin to invest in the stock market. Now, I know you guys are probably noticing a different view here with my office. I've just been having so much trouble trying to get the lighting correct in my new apartment that I'm going to go back and use my old set that I was using a couple of months ago before I moved. Just because this is a much better environment for the lighting, and I'm still going to tinker around and hopefully get the lighting okay at my apartment so I can do a combination, but it seems like overall this was the best area to record my videos with the right lighting. But I've heard a lot of people talking about this. I've seen a lot of videos on this. It's this whole idea of waiting for the stock market to crash before you begin investing in the stock market. And I kind of want to debunk this today and talk about why maybe this sounds like a great idea on paper, but in reality, it's not going to work the way that you are expecting it to work. Now, first of all, I do have to do my giveaway for Stock Radar. Every single week, I give away a free lifetime membership to that. And this week's winner is El Coyote24. You commented on my Instagram, hashtag Stock Radar, so you've won a lifetime membership to my stock analysis membership site. This week we talked about Hua, H-U-Y-A, that is the Twitch of China, one of those Chinese stocks that recently went public that has been a wild ride for investors for a number of reasons. But that's going to be opening up again in August. If you guys are interested, stay tuned for more details on that. But this idea of investing when the stock market crashes comes down to this investing principle of buying low and selling high. So we all know that when we invest in stocks, you don't want to be buying stocks that are hitting all-time highs. You want to invest in stocks when they are cheap, when the stock price is low, and then sell at a higher price down the road. And we know that over time, in a bull market, the market becomes more and more overvalued. When you look at things like the price to earnings ratio, you see what the earnings multiple these companies are trading at. And so a lot of people get this idea that the whole market has become overvalued and I should sit in cash on the sidelines and wait for this market to correct, and then I will put all of my money into the market at the perfect time and I'll be able to ride it from the bottom all the way back up to the top, and then I'm going to sell again. But there's a lot of problems with this idea. The first problem is the fact that there's no way to tell when you're going to be at the top of the market or the bottom of the market. And I know there are a lot of people out there that would like to convince you otherwise. They want you to believe that they have some magic 8-ball that's going to tell them the exact time when the stock market's going to crash. They're going to look at this specific ratio. But there's no way to tell whether or not the stock market is going to crash tomorrow, next week, or next year. And so this idea you'd be able to time it and get out at the right point and then get back in is an idea that is not true. It's impossible to be able to do this. So my question to those of you that do have this idea of timing the market and getting in at exactly the right time is, what exactly are you looking for? Are you waiting for the stock market to fall 20%, 25%, 30%? Are you waiting for a massive correction to take place? Now, I'm not saying that you shouldn't, have a general idea about where the market is just in the way you're investing. That is a wise idea. Don't be lump sum investing or dumping a ton of money in at the top of a market, but you can't sit there and say that you're going to wait for the stock market to crash before you start putting money into it. And the main reason for this is that there are not many alternatives to investing in the stock market. If you put your money in your savings account, you're going to earn about a 0.5% interest rate. And we all know that inflation is around 2% per year, so you're going to be losing a massive amount of money to inflation. Now, yes, it is a good idea to keep some cash on the sidelines within your investing account. So we have our emergency fund, that is for all of your emergency expenses. And then you have cash on the sidelines that you're not investing, but you have it sitting there in case the right opportunity comes around, or maybe you've taken some profits off the table and you've built up a cash reserve. I have no problem with that. I personally have a large cash reserve at this point in time. But my problem is with the people who have 100% of their money in cash. You're earning 0% rate of return or some very paltry amount of interest from your savings account. Your money is being deteriorated by inflation and you're waiting for the perfect time to get back into the market. Now, another big problem with this idea of waiting for the stock market to crash before you invest is the fact that when the stock market does in fact crash and bottom out, that is at the maximum point of pessimism. That is when the sky is falling. Companies are going bankrupt left and right. And I know it sounds like a good idea on paper of, okay, I'll wait until exactly that point and I'll funnel all of my money in, but you gotta have some serious guts to be able to do that, because every person around you is going to be telling you that you're an idiot, that you shouldn't be doing that stocks are going, nowhere but down, because that's all they have done previously. So this idea that you're gonna even have the stomach or the emotions to be able to do that, or that tolerance for risk, is also something that is just not true for most people. If you're afraid to be investing in the stock market right now, you're not going to be liking the idea of investing when you keep seeing the numbers fall and everyone around you is getting out of the stock market. So it's an idea that does sound good on paper, but it just doesn't work well in practice. Now, the one thing I will say is this: I understand the idea of waiting for an individual stock to have a crash or a correction before investing, because we don't want to be investing in stocks at all-time highs. The saying is not buy high, sell higher, it's buy low, sell high. And waiting for a stock to come back to reality is a good idea, and that is something I do myself as well. So if you are going to be waiting for a stock to crash or correct before investing, I do agree with that school of thought, but a lot of people have missed out on opportunities by doing that. I know a lot of people were saying, Amazon stock is $1,000 a share. How could anybody invest in it at that price? I'm going to wait for it to come back to reality. And now we're seeing Amazon stock at $1,700 a share. So I bet a lot of people were waiting for that stock to correct. It's really had no correction whatsoever, and it just keeps on going up. So there are instances where stocks are not going to have a pullback, and by waiting to get in, you're going to miss that entire ride. But again, I do not recommend investing in stocks at all-time highs. I don't do that personally, but if you are waiting for a stock to correct or crash, it may not happen the way you are expecting it to, or you might have to be very patient and wait for a very long time to see a pullback happen with that stock. But I do understand the idea of waiting for a stock to come back to reality before you start buying shares of that stock. So rather than waiting for the stock market to crash, I want to share with you guys a couple of strategies that make a lot more sense. And number one is dollar cost averaging. So instead of putting all of your money into the market or taking all of your money out, you're going to be regularly accumulating shares of an index fund or individual stocks over a long span of time. And by doing that, you're paying the average price for those shares over a long span of time. So maybe you like Apple, or maybe you like Facebook stock, and you wanted to have, $100,000 invested in that stock. I wouldn't recommend putting all of that money in at once. You'd invest a couple $1,000s every single month and buy shares over a long span of time. And by doing that, you can sit there and not have to worry about whether or not the market is going up or the market is going down, or that particular stock is going up or down, because when that stock price goes down, you're accumulating more shares, and when you buy it at a higher price, it's going to average out and you're going to pay the market average for those shares. So the number one strategy is just dollar cost averaging, regularly accumulating shares over a long span of time. The second thing that you can do if you are worried about the market becoming overvalued is to simply increase your cash reserve or your cash pile, the money you're keeping on the sidelines. I'm not saying you should move into 100% cash. I hope we dispelled that already. But if you do want to build up your cash pile and hold on to more cash and then invest more when you see the opportunities arise, that is a good strategy to follow as well. Number three, you might be interested in exploring some different investment avenues. Maybe you're going to look at real estate. I know personally I've been investing in Fundrise, and that allows me to invest in private commercial real estate projects. So returns have been kind of lousy with the stock market, and that might be a time when you begin to explore different investment options and see other ways that you can earn a return for your money and outpace inflation. So exploring other investment avenues is a good option, but avoid leaving your money in your checking account and earning a paltry rate of return for interest. And then fourth and finally, as we discussed, waiting for a stock to correct is not a bad strategy, waiting for that price to come back to reality before investing. But like we said, you might miss out on some opportunities, as there are stocks out there that have not really seen a correction, stocks like Amazon. But we don't want to be buying stocks at all-time highs, so waiting for a stock to come back to reality is a good strategy. But anyways, guys, that's going to wrap up this video. I hope I dispelled this myth or this idea that it's possible to wait for the market to crash before entering. Your best bet is to just stay the course and maybe follow some of the strategies outlined in this video. But thank you guys so much for watching, and I will see you in the next one. If you are interested in learning more about investing in the stock market, I've created a free course just for you. The link is in the description below. Here are a few other videos you might enjoy as well.